You may have heard that Warren Buffett pays less in taxes than his secretary, even though he makes millions. How is that possible? Well, it has to do with the progressive tax system in the United States. This system aims to tax people based on their income levels, with higher earners facing higher tax rates. However, the tax system is not as simple as it seems. There are different types of income, such as earned income, passive income, and portfolio income, each with its own tax implications. There are also various tax advantage accounts, such as 401ks, IRAs, and HSAs, that offer unique benefits to reduce your tax liability. And there are strategies like capital gains harvesting and Roth IRA conversion ladder that can help you optimize your tax outcomes. In this video, we'll explain how these concepts work and how you can use them to legally minimize your tax bill. This is the Finance Virtuoso channel, where we talk about all things finance. For your daily dose of valuable information on money, business, investments, and savings, be sure to hit the subscribe button and click the notification bell right now. Unveiling income types for strategic tax planning. The first thing you need to know is the three fundamental types of income recognized by the IRS: earned income, passive income, and portfolio income. Earned income is the income you get from working, such as wages, salaries, tips, or business income. This type of income is subject to ordinary income tax rates, which range from 10% to 37% depending on your income bracket. Passive income is the income you get from activities that do not require your active involvement, such as rental income, royalties, or profits from partnerships. Passive income is usually taxed at ordinary income rates, but there are some deductions and exceptions that can lower your taxable income. Portfolio income is the income you get from selling assets, such as stocks, bonds, or mutual funds. Portfolio income is classified as either short-term or long-term capital gains, depending on how long you hold the asset. Short-term capital gains are taxed at ordinary income tax rates, while long-term capital gains are taxed at lower rates, ranging from 0% to 20%. By understanding the differences in tax treatment among these income types, you can strategically allocate your resources and minimize your overall tax liability. For example, you can invest in assets that qualify for long-term capital gains treatment, or you can use tax advantage accounts to defer or avoid taxes on your income. The power of capital gains, harvesting, and long-term strategies. One of the key tools in the arsenal of tax-savvy individuals is capital gains. Capital gains arise from the increase in value of your assets over time. By harnessing the power of capital gains, you can reduce your tax bill significantly. Capital gain harvesting is the strategy of deliberately realizing capital gains to take advantage of the lower tax rates. For example, the tax code provides a 0% long-term capital gains tax rate for individuals in the lower income brackets. By selling these assets that have appreciated in value and staying within the 0% tax bracket, you can avoid paying any taxes on your gains. Long-term capital gains are the gains from assets that you hold for more than 1 year. Long-term capital gains benefit from lower tax rates than short-term capital gains, which are the gains from assets that you hold for 1 year or less. By holding on to your assets for longer periods, you can optimize your tax efficiency and keep more of your investment returns. While long-term capital gains offer favorable tax treatment, there are some exceptions and additional considerations that you should be aware of. Some assets, such as collectibles or precious metals, may have a higher tax rate of 28%, even if held for a long time. Also, if you have a lot of investment income, you may face an extra 3.8% net investment income tax. Moreover, you should consider the state-level taxes, as some states may have different rules for capital gains. Choosing to live in a state with low or no capital gains tax can be a viable option for achieving greater tax efficiency. Tax advantage accounts, your secret weapon. Another powerful tool for tax planning is the use of tax advantage accounts. These are special accounts that offer unique tax benefits, such as 401ks, IRAs, and HSAs. By using these accounts, you can reduce your current and future tax liabilities. 401ks are employer-sponsored retirement plans that allow you to contribute a portion of your income on a pre-tax basis. This means that your contributions are deducted from your taxable income, lowering your tax bill for the current year. Moreover, your contributions grow tax-deferred until you withdraw them in retirement. For 2023, you can contribute up to $22,500 to your 401k, with an extra $7,500 if you are 50 or older. By maxing out your 401k, you can potentially save thousands of dollars in taxes and build a substantial retirement nest egg. IRAs are personal retirement accounts that come in two forms: traditional IRAs and Roth IRAs. Traditional IRAs allow you to make pre-tax contributions similar to 401ks, but with a lower limit of $6,500 per year, or $7,500 if you are 50 or older. Roth IRAs, on the other hand, allow you to make after-tax contributions, meaning you do not get a tax deduction for the current year. However, your withdrawals, including the gains, are tax-free in retirement. One of the best strategies for tax planning is the Roth IRA conversion ladder. This involves converting funds from a traditional IRA to a Roth IRA over time, paying taxes on the converted amount at a lower rate, and then accessing the funds tax-free after a waiting period. This can help you avoid taxes on your retirement income and optimize your tax outcomes. HSAs are special accounts that offer a triple tax advantage for those with high-deductible health insurance plans. You can make pre-tax contributions to an HSA up to $3,850 per year for individuals, or $7,750 for families, with an extra $1,000 if you are 55 or older. You can also invest your contributions and enjoy tax-free growth, and you can withdraw your funds tax-free for qualified medical expenses. HSAs can serve as a powerful retirement savings vehicle, as you can use the accumulated funds for medical expenses in retirement without paying any taxes. Alternatively, you can withdraw the funds for any purpose after age 65, paying only income tax. By using these tax advantage accounts, you can shape your tax liability during your working years and prepare for a tax-efficient retirement. These accounts can help you save thousands of dollars in taxes and secure a robust financial future. Crafting a tax-efficient lifestyle. To illustrate how these concepts work in practice, let's look at a fictional example. Meet Jim and Jen, a 30-year-old couple. They want to minimize their tax bill while building wealth for the future. Here's how they do it. Expense management. They start by managing their expenses and living below their means. They adopt strategies like rent and transportation hacking to lower their annual expenses. This allows them to save more of their income and reduce their tax burden. Maximizing tax advantage accounts. They then maximize their contributions to tax advantage accounts. They both contribute the maximum amount to their 401ks, IRAs, and an HSA. This reduces their taxable income, saving them thousands of dollars in taxes and growing their retirement savings. Taxable account investments. They invest their remaining income in a taxable account. They choose assets that qualify for long-term capital gains treatment, such as index funds or ETFs. This sets them up for future capital gains, harvesting, and long-term tax efficiency. Capital gains harvesting and long-term strategies. They retire at age 50 and start harvesting their capital gains. They sell a portion of their investments each year, staying within the 0% long-term capital gains tax bracket. This allows them to avoid paying any taxes on their gains and reset the cost basis of their holdings. They also use the Roth IRA conversion ladder strategy to convert their traditional IRA funds to Roth IRA funds over time. They pay taxes on the converted amount at a lower rate and then access the funds tax-free after a waiting period. Tax-efficient withdrawal strategy. They fund their retirement lifestyle from their taxable account using the 0% long-term capital gains tax bracket. They also sell and repurchase their assets strategically, avoiding substantial tax bills and maintaining control over their taxable income. Required minimum distributions (RMDs) planning. They plan ahead for the age of 72 when RMDs kick in. They explore options such as charitable contributions, strategic Roth conversions, or other techniques to manage their RMDs effectively and avoid paying unnecessary taxes. By following these steps, Jim and Jen achieve a tax-efficient lifestyle, paying minimal taxes while securing their financial future. This example shows how you can apply the principles we discussed earlier and craft your own tax-efficient financial strategy. As you can see, the key to legally minimizing your tax bill is to understand the rules of the game and strategically use the tools at your disposal. By applying the concepts and strategies we discussed in this video, you can optimize your tax efficiency and keep more of your hard-earned money. If you found this video helpful, please share it with your friends and join us in our financial revolution. Thank you for watching and stay tuned for more finance virtuoso tips.